If you invest in triple net leases, or you're thinking about it, there's a shift happening right now that you can't afford to ignore. What's up, hungry investors? Welcome back to the channel. I'm Christian Cotta. ESG, environmental, social, and governance standards. They're no longer just buzzwords for big tech companies or sustainability consultants. It's the framework used to assess a company's sustainability and ethical impact beyond its financial performance. They're now directly impacting how capital moves in the net lease space. And if you're not factoring ESG into your deals, you might be setting yourself up to be passed over by both tenants and buyers. In this video, I'm going to break down why ESG is gaining traction in commercial real estate and how it's already reshaping deal flow, and what smart investors are doing right now to stay ahead of the curve. So here's what's happening. Institutional capital, pension funds, REITs, private equity, they're all under pressure to meet ESG benchmarks. It's not optional anymore. These investors are now funneling money toward properties that align with sustainable and ethical governance goals. And that affects you, even if you're investing in a single tenant triple net asset in a secondary market. Because here's the truth. If your tenant is a public company, they're almost guaranteed to have ESG targets too. And if your property doesn't support their environmental goals, or worse, works against them, you're gonna feel it in lease renewals, in valuation, and in who's even willing to buy it down the road. We're seeing three big shifts right now. First, investors are prioritizing green certified properties. If it's got LEED certification, solar panels, energy efficient systems, it's more attractive. And not just for the tax benefits or reduced operating expenses, it's a signaling tool for ESG focused capital. Second, ESG language is starting to show up in lease agreements. Tenants want to know their landlords are on board with energy tracking or sustainability metrics, especially if they're publicly reporting. And third, capital is flowing to ESG aligned deals, period. You might have two nearly identical triple net deals, but if one is a climate risk zone and the other isn't, one gets bid up, the other sits. We're seeing this play out in live deals right now. So what can you actually do about this? Here's what the smart money is doing. 1, auditing their portfolios for environmental risk and energy inefficiencies. 2, partnering with tenants on modest upgrades like lighting, HVAC, or solar, even under triple net structures. 3, repositioning acquisitions by including ESG improvements in their underwriting. And most importantly, targeting deals that align with the ESG mandates of their future exit buyers. Because here's the thing, even if you personally don't care about ESG, your buyer might, and they're gonna pay or pass accordingly. So if you're building a portfolio you wanna hold or exit over the next 3, 5, or 10 years, this is one shift you can't afford to ignore. If you want to dig deeper into this, how ESG is impacting underwriting, how it affects different asset types, and how to position your portfolio, we break it all down in a full article on our blog at hungry-inc.com. You can also find the link below. Join the conversation. Leave a comment below with your thoughts on how you plan to take this information and use it. Thanks for joining me and watching this video today. If you enjoyed the video, don't forget to like and subscribe for more commercial real estate insights and info, and help us reach our goal of building this community of commercial real estate professionals and investors to 10,000. See you next time, and as always, stay hungry, my friends, because rent's due.